Welcome again to EWTA. Till now we have learned about trend and trend lines. Continuing this topic, today we will know about the trend patterns. We can easily recognize uptrend and downtrend. But when the market is in sideways trend, do we know about the future trend? Yes, when market is trendless or ranging, some chart patterns formation is there which helps us to know and understand about the new trend. Chart patterns show buying and selling in the pictorial form so that we can take decision about the future trend. Accordingly, trade in that particular direction. They can be used on short-term and long-term time frame both. The data can be intraday, daily, weekly or monthly, and the patterns can be as short as one day or as long as many years. Majority of chart patterns fall in two groups, reversal and continuation patterns. In this part, we will cover only reversal patterns. Reversal patterns give us an indication of change of trend. When the direction of trend changes as from uptrend to downtrend or downtrend to uptrend, these patterns can be seen in the chart. Our first reversal pattern is head and shoulder pattern. Head and shoulder pattern is the reversal pattern and mostly seen in uptrends. In an established uptrend, sellers become dominant at highs, result in decline and forms left shoulder which takes support on a line which we call the neckline. Buyers try to push the prices and resumes buying which takes the stock or market to new highs forming head. This is the head formation, but it also takes support on neckline. This is the same line as a support line and head is also taking support on this neckline. As market rallies once more but fails to move above the previous high and once again tests the neckline. This is the right shoulder formation. You can see here that the peak of the right shoulder is below the peak of the head formation. It should always lower than the head's high. When the prices falls below neckline, the prices are now trying to cross down this neckline and they also trying to cross this neckline but fails. Then the downtrend extends. We can make our short sell position at breaching point of this neckline. When prices cross this neckline in downward direction, we can make our short sell position and we can employ a stop loss at the peak of this right shoulder. If we get the high volume on this breakout, then the pattern is confirmed and we can surely make our short sell position here. In this example, prices are in uptrend and this peak is taking support on a line. Then a head formation is there. The peak of the head is always higher than the peak of the left shoulder. It is also taking support on the same line which you call the neckline. Now it is the formation of left shoulder and when we get a breakout on this neckline in downward direction, we can make our short sell position here. Here we can see the prices are also trying to touch this neckline or they are trying to cross this neckline in upward direction but they fails. It means it is the end of this uptrend and a reversal of this downtrend. So we can make our short sell position here with the stop loss at the peak of this right shoulder. Points to remember here are most head and shoulder pattern are not as perfect symmetrical as shown in this figure. Many head and shoulder pattern consist of either multiple left shoulder or multiple right shoulder. In this chart we can see there are two shoulder here and they both are taking support on this neckline. Also there are two shoulder, right shoulder here. They both are taking support on this same neckline. Instead of being horizontal, the neckline might be sloping a little up or down. But if the neckline is upsloping, make sure that the lowest point of the right shoulder must be lower than the top of the left shoulder. It means if this neckline is slightly sloping up in this way, then the support of this right shoulder should be lower than the top of this left shoulder. Inverted head and shoulder pattern is simply the inverse of head and shoulder top formation. This formation too consists of a left shoulder, a head and right shoulder, but it suggests a trend reversal from down to up and it is commonly seen in downtrend at the end of the downtrend. The left shoulder is formed usually at the end of an extensive decline. At the end of the left shoulder there is a small rally and this rally usually occurs on low volumes. The head is then formed and finally the right shoulder is formed by a rally. A neckline can be drawn across the top of the left shoulder, head and right shoulder. This is the resistance line and we can call it neckline An upside breach of this neckline on a rally from the right shoulder is a final confirmation and completes the head and shoulder bottom formation. And this is a signal to buy. The pattern signals the end of the downtrend and starting of the uptrend. So we can buy here when this right shoulder top is breached this resistance line in upward direction. But one should remember buy when the neckline is breached on the closing basis only. It means that the candle should close above this resistance line on the daily basis. This is the example of inverted head and shoulder pattern. This is the downtrend. Prices are in downtrend and the top of the left shoulder, and this is the head formation, top of the head and the top of this right shoulder. They are resisting this line which we call the neckline. When we get a breakout of this neckline in the upward direction, we can make our buy position here. The low of the head should be lower than the low of this left shoulder and this right shoulder. The volume at the breakout should be higher than the average, and this is the confirmation of this pattern. Rising wedge. This pattern indicates the starting of the bear or downtrend. The series of higher highs and higher lows keeps the trend bullish, which can confuse us about the future trend. We can simplify the matter when the pattern is on finishing stage. Most of the indicators are overbought and negative divergence can be seen. We will learn about the indicators and divergence in the upcoming modules. The rising wedge pattern begins wide at the bottom and contracts at the top. We can see this is the starting of the rising wedge pattern and it is wide at the starting and this contracts at the end of the pattern. When we get breakout on this lower trend line in downward direction, we can make our short sell position if we get negative divergence on RSI. This is the example of rising wedge pattern. The prices are in uptrend and here they are making higher tops and higher bottoms. So if we get a breakout on this trend line with higher volume and also we get a negative divergence at here at this point, we can make our short sell position. It is the confirmation of the end of this uptrend and starting of the downtrend. Falling wedge is a bullish pattern seen in a downtrend. It is an indication of uptrend. Patterns begins wide at the top and contracts at the low. Positive breakout is seen when the resistance formed by this upper trend line of the wedge is broken. If we get a breakout at this upper trend line in upward direction, we can make our buy position here. It is a confirmation of the end of this downtrend. Always wait for the confirmation by the indicators and divergence before initiating any position of this pattern, because at the breakout of this pattern we must get a positive divergence on RSI. In this chart, prices are in downtrend and they are making a falling wedge pattern. Here we are getting a falling wedge pattern with a breakout in downward direction. So we will not make any buy position here. But after making this fake breakout, suddenly prices are going in upward direction, and when we get a breakout from this resistance line, this upper trend line in upward direction, we can make our buy position here if we get a positive divergence on RSI. Double bottom pattern can be seen in short term as well as long term time frame. A bottom is formed and then pullback resumes, which can continue till it faces a major resistance line. After touching the upper resistance line, prices fall back to the previous low and rise again to upper limit. This time prices cross the upper limit and breakout takes place. A W-like formation is completed and prices move in uptrend. This is the example of double bottom pattern. Prices are in downtrend and take support on a line. After taking support, prices are going to touch this resistance line and again a rally occurs and we get a breakout on this resistance line in upper trend line in upward direction. When we get a breakout in upper direction from this line, we can make our buy position here with a stop loss at the low of this candle. Double top pattern is a bearish pattern and can be seen before the starting of a downtrend. In an established uptrend, when the last peak is formed, this is the last peak, and the next peak fails to cross the old one. This is the second peak and This is at the same level of the first peak. The low of these peaks are taking support on the same support line, and when we get a breakdown from this support line in the downward direction, we can make our short sell position. The latter M-like formation is there, and the pattern is completed when we get a breakout in downside at this support line, which we call the neckline. Between the double top and double bottom pattern, a gap of minimum 3 to 4 weeks can be considered. And never assume the formation of a double top pattern until the neckline is actually breached, because in an uptrend each new rally after reaction could appear to be making a double top. The two tops must be separated by a deep and long reaction. If the two peaks are close together in time, then it signifies consolidation rather than reversal. Volume during the rise of the second peak must be lower than that during the rise of the first peak. This is the example of double top pattern. Prices are in uptrend and the both peaks are taking support on the same support line, which we call the neckline. Here we get a breakout on this neckline in downward direction. Prices are touching this neckline and trying to cross it in upward direction, but they fail. So we can make our short sell position here with a stop loss at the top of this right peak. Broadening triangle pattern appear much more frequently at tops than at bottoms. They are assumed as the top reversal pattern and have bearish implication. A broadening triangle pattern is a powerful reversal chart pattern which occurs frequently in the later part of an overextended bull rally. It consists of three successive peaks, each higher than the previous one. The peaks can be 3 or 4 in some cases. The peaks are higher than the other and lows are lower than the other. When we get a breakout on lower trend line, we can make our short sell position with the stop loss at the top of this last peak. Here the prices are in uptrend and we are getting a broadening triangle pattern at the top of the bull trend. As we can see, the peaks are higher than the other peak and they are making lower bottoms. We get a breakout at this lower trend line with a gap. Here in this example, we are getting a gap with a higher volume. So at the starting of this red candle, we can make our short sell position with the stop loss at the high of this last peak. Rounding bottom is a long-term reversal pattern. It takes a lot of time to complete. On daily charts, it is not clear because of noise, but on weekly charts, its formation gives a clear signal. After a long consolidation period, it turns from a bearish trend to bullish and forms a saucer-like shape. We should buy the stock near the end of the saucer curve from where the beginning of the bull trend starts.